Hello everyone and welcome to a new ATFX video. My name is Gonzalo Cañete and this is the ATFX Connect Market Snacks. Quick review of the situation of the market. Today is Tuesday, 12th of December. It's actually a really important week. I'm gonna share with you first thing the calendar so we can take a look of what we can expect this week. The last data published by United States a few minutes ago, which is the CPI index, inflation index basically, has moved the market in the last few minutes. I would like to also share with you the movements on the market, and let me change the screen so I can share the charts with the last update. Here's the Standard & Poor's. We can see also that the mini Standard & Poor's future is moving down after the data release on inflation in the United States. But on the same hand, we can see also the 2 years US bond, Treasury bond, rising up, which is a very common movement between fixed income and equity. As you can see, because the inflation rate published, it was exactly in line with the expectations. I believe the reaction on the market is they were expecting probably even lower interest inflation rates due the same levels of inflation, which is, by the way, it's in line with the 3 point. I think we came from 3.2 to 3.1. Let me share also that with you. We got 3.1 now on inflation rate on United States versus the 3.2 on October. And don't forget that in June we registered 3% of inflation rate in the United States, and after that one we got 3.2 and 3.7 inflation rate. So actually it was rising back again this summer, the inflation. That's why it was provoking also kind of bearish market by the end of the summer. So in summary, high inflation is not good for the market because it's forcing a Federal Reserve to take more restrictions in terms of liquidity, and therefore Wall Street doesn't like those restrictions. The market wants actually high liquidity, high facilities for credit and loans, and therefore for buy digital financial assets. So as you can see here, the reaction, let's even move to a lower term. As you can see, the reaction of the market is in terms of equity dropping. Tomorrow is a very important day, and if you don't remember, once again I'm gonna remind you, I'm published on ATFX Connect on our X account and also on our blog all the data related with macroeconomics updates every single day, every single morning. And just as a reminder, yesterday I give to you a summary of the week. Yesterday wasn't a very important macroeconomical data on Monday, but still it was a good day to put in order and list all the events that we're gonna face during the week, starting mainly by tomorrow. Today the most important numbers, it was the inflation IPC index from United States. It's already gone. We have seen the reaction of the market, but still tomorrow we got Wednesday, UK published GDP growth rate, industrial production and trade balance. So if you are actually trading on pound, this is important for you. We also got for Wednesday, China will publish the new corporative credit issuance. So we're gonna see actually what kind of measures China is taking. Just as a reminder, also we got the recent data for the last few days from China is again showing deflation. Even in a PPI index, which is the price on production index, so inputs to the industry are dropping the prices, and therefore we consider that if PPI are dropping, that means like the inflation also will drop, which is the opposite problem that West countries has been facing the last year. It's actually deflation risk, which means like the economy of China should probably is slowing down, and that's the main fear for the rest of the for the global economy. So tomorrow, all of these numbers we say, but the most important one is the PPI index from the United States and the Federal Reserve decisions. Federal Reserve interest rates decision tomorrow is probably the key event for the week. Still, on Thursday, we're going to have interest rate decisions from European Union, Bank of England, and also Swiss National Bank. So it's actually caused a lot of volatility the next 48 hours probably. And that's why I want to keep you completely updated about all that is going on. You got also the summary of the day for today on 12th. I was just mentioned the employment rate published by United Kingdom, which is in line what they were expecting, still below the average in Europe. What else? Average earning index is dropping from 7.7 expected to 7.2, which is also not a really positive sign for United Kingdom, but depends where you are looking for. If you're looking for predict or try to estimate the next step from Bank of England on monetary policies, this number is actually in pro of no actions from Bank of England, and therefore this is positive for the London Stock Exchange. We also got the indicator of economy of German, the CEF, CZEW. In terms of economic situation, the index is dropping again. Just as a reminder, Germany has been decreasing the industrial activity and economical activity in general terms for the last year. 5 consecutive months dropping in industrial production in Germany, which is worry or generate concerns for European economy. We also got the what else? Oh yeah, Dutch economy. We have seen also by Reuters a study projection and also poll related with what's expectation of the Dutch economy for the coming year 2024. It's interesting because it's one of the economies that it was actually in recession next to Germany. It's included in the top 5 of main biggest economies in European Union, and it was also in recession, decreasing the industrial production and so on. So Reuters was mentioned that they expect that they actually could get out of the crisis after 3 quarters with negative growth. They could get out or exit, leave back this recession, but the trick is close to the massive or big fiscal stimulus, public expenditure pushing. There is charts about this. I also share the charts on our social network, so you can see actually how the expenditure of the government is rising, and that's what exactly is increasing the stimulus for the economy. And it's interesting because Dutch economy, with next to the German economy too, is one of the most conservatives from an economical perspective, and it's interesting to see how they actually twisting and using certain more interventive tools, Keynesian tools, to recover the economy, paradoxically. So it's interesting. We also, the China deflationary risks persist. China customer prices fall the fastest on 3 years in November, while factory gate deflation dipped, indicating rising deflationary pressures as weak domestic demand cuts stopped over the economic recovery. You got all details there. You also got macroeconomical measures there. And now, finally, let's take a quick look on the charts and see, well, as you can see, I'm gonna share the whole screen with you so you can see the levels properly. But we can see how the SP500, mini SP500 actually, the mini future, is dropping the price. Probably the spot is doing almost the same thing. Still, there is a gap. It's in contango. We call this contango. Futures are quoting above the spot levels. But the reaction of the market is clearly bearish to the data published by the inflation rate, basically. Nasdaq is moving in the same direction. From the European size, we also see that it's affected because it's dropping a little bit. The market also. Spanish index doing the same thing. So it seems to be, we're in 30 minutes, but if you take a look with long distance from a better angle or perspective, you will see that actually this is showing us that certain, especially for European market, could be even more dilatations there, but for the rest of the markets, particularly from US market, you can see that it's actually after these 3 massive movements jumping over and over and over, it looks like it's inviting for sales. Let's take a look also what's the reaction of the dollar, because dollar is particularly super well connected with the inflation, basically because it's the currency and is reacting to the monetary policies, and therefore inflation is the first variable used for the central bankers to decide the monetary policies. So as you can see, dollar is trying to recover certain levels. There is a very interesting pattern here that some people probably are identifying already. which could be a reversal shoulder head shoulder that push the price up back to track on a bullish trend on dollar, but still should be confirmed. And this chart that kind of movement will only happens if the Federal Reserve is actually twisting back to a hawkish position, more strong, more straight, and not what has been discussed for the last 4 weeks, which is a dovish Federal Reserve that potentially will cut interest rate by March. By the way, the swaps are also discounting that probably the interest cuts instead of March will come probably by May. Where we got it? Somewhere here. You will see US terms gains trades now below. Here it is. Short-term interest rates futures per early gains traders now betting on May 2024 for the first Fed rate cut versus early bet on March. So after these inflation numbers, traders believe that actually the interest cuts could happen not in March but even in May later. So it's Q2 of 2024. That's the expectations. And based on that, we also probably got a reaction on gold, which is still dropping because the dollar is getting stronger, as you have seen. Everything is in line with this reading. Fixed income, yields rising, equity dropping, dollar getting stronger, gold dropping because the dollar is getting stronger, and oil markets still dropping because the dollar is getting stronger. Very interesting. I think that's all for today. Hopefully, I'm gonna see you in the coming reports. And remember, if you like this content, if you like these comments, please leave me a like on the channel, subscribe if you like it, and also leave any kind of comment if you want to suggest any other topic to discuss on these videos. Take care and see you in the next Market Snack update. Bye bye.